Welcome to the Planning to Win podcast. My name is Tom Lakatos. I'm a senior vice president at Lincoln Investment. The likelihood of your success financially increases when you are able to articulate your goals, when you share them with other people, and you write them down. In our experience as advisors, we can help you with some of the basic building blocks around financial planning and tackle some of the more common questions to help jumpstart your planning. And we're looking forward to bringing that to you in this series. The question comes down to, do you intend for the death benefit to actually pay to your family? Sometimes now, in an effort to be more competitive, you can get return of premium back.
You can always go about taking loans out, right? There's just a lot of things you can do with that. It's another pool of money.
They build policies that have investment vehicles and investment features. There's also some serious tax benefits. If I stopped paying on my life insurance policy, the premium could come from the cash value and sustain the rest of my life. Hi, folks. Welcome to this week's episode of Planning to Win. My name's Tom Lakatos, Senior Vice President at Lincoln Investment. I'm excited to bring this week's installment to you. As you know, this is a podcast that's really built around actionable ideas designed to help increase the likelihood that people get what they want out of their financial lives. This week, I'm here with Kyle Webster. Kyle, this is a continuation of October is National Financial Planning Month. September was National Life Insurance Month. So we've been talking about life insurance a bit as a foundational component of people's planning. And I got a couple of things I want to get into with you. And before we do, I'm hopeful, can you take a minute and just introduce yourself a little bit to our audience?
Sure. So Kyle Webster, been here about 3.5 years. Been in the industry for about 11. Married about 3 years ago to my wife, Courtney. Got a 2-year-old daughter. And I got a 4-year-old fluffy white dog, Samoyed, named Sasha, who keeps us busy.
Sounds like it. I remember when I had a 2-year-old. I can only imagine. Well, this is timely for you then as a parent, right? The concept of, being a provider for your family and making sure, one of the things that we often talk about, and we talked about a lot in last week's episode, was we talked about the fact that adversity happens, right? As financial advisors, we know that people are going to face adversity in their lives. It's not a question of if, it's a question of when, and are they prepared? And there are various types. One of the types that's most devastating to families is a premature death. Right. And so, last week we talked a lot with your colleague, Michael, and we had talked about why you need insurance, which I thought was a really good conversation. And we had talked about some needs being sort of finite, like a home or a kid's college. We talked about some, income replacement or multi-generational wealth or, caring for people with special needs as examples. What I want to talk about with you, Kyle, and I know you deal with this in your client base a little bit, but the next two questions after, why do I need it, that we usually get is what type of insurance do I need? It's confusing, and how much coverage should I have? And again, all we're trying to do is really address sort of the more common questions so that when we spend time talking to our clients, we can get into the nuances a little bit. So let's start with the concept of what type of insurance. Kyle, when you think about that, what are some of the things that come to mind?
Yeah, I think the $1 million question we ask is, do you want it to pay out or not, right? There's varying studies out there, but they all kind of end up around the same area, which is 98 or 99% of term policies do not pay out, right? So we kind of start there where it's like, do you want this to pay out for you, right? If we're talking about the big two types, right, you have term insurance, think of that as kind of getting you from point A to point B. And then you have permanent insurance, right? That's your kind of whole life, or you have universal life kind of below that. But that's more so, you go through the underwriting once, right, in your lifetime, and it's not just covered for a period of time. It's going as long as you continue those payments.
Yeah, talk a little bit about, let's talk about term first. So, I think about different ways that we can cover term insurance. Can you talk just a little bit about, I know some people, when we deal with their clients, often the first thing we say is, hey, are you maxing out the coverage that you get from your company? And if you are, then you look at a term policy outside that for things like a mortgage or a kid's education, where, like you said, the question comes down to, do you intend for the insurance to actually, when you say pay out, what you mean is do you intend for the death benefit to actually pay to your family? Right? There are some risks in your life where you would buy the coverage, as an example, and hope that it doesn't pay out. Like, I intend to be alive when my mortgage is paid off, right? I intend to be alive when my kids graduate from college. I don't want that death benefit to pay, so I would use term to cover that. Talk a little bit about how you think, just a little bit about sort of the mechanics, group coverage versus your own personal term policies, and why both is usually a pretty good strategy?
Yeah, I think, the stuff you get through work, it might be 1.5, 2 times your salary, something like that, if they offer that type of benefit. The moment you leave that company, it's usually gone, right? So we have that conversation of, hey, do you have that type of coverage? Company offering it, great. That's usually where you start. And then as far as introducing, kind of personal insurance outside of your company or group, just offers you a ton of flexibility.
Yeah. Well, and some we've seen some employer group term life be convertible to permanent or personally owned policies, but usually there's an underwriting process to that, and as you mentioned, most don't. And term policies usually run 20, anywhere from 10 years to 30 years. Sometimes now, in an effort to be more competitive, you can get return of premium back, although there's usually some cost to that. Talk about, just to clarify, what makes a policy a permanent policy? And then you'd mentioned a couple different types, like whole life and universal. Are there others? Just talk a little bit about, kind of what makes it permanent insurance and what some of the different options are.
Yeah, so with permanent compared to term, you're building up what's called a cash value, right? You're paying that premium, and over time, you're building up this kind of pool of money. There are a bunch of different types out there, but kind of the big two I point out are whole and universal. So usually with whole life, that cash value is growing at kind of a consistent rate over time. Versus the universal, you have the ability to invest that if you want to, right? Depending on the policy. So you get some growth out of that. When I talk about flexibility, you can always, I'm not going to get too far down the rabbit hole here, but you can always go about taking loans out, right? There's just a lot of things you can do with that. It's another pool of money. And over time, right, that money that you have in that cash value can help pay for the policy. The moment you stop paying on term, right, it's usually gone.
Yeah, that's really important, right? Because I think especially when you deal with higher net worth clients, right? The reality is that life insurance, that's why I say it. In our last episode, I talked a little bit about the image of the life insurance industry, right? The stodgy guy in the tweed jacket selling policies door to door in the 1930s, right? This isn't that, right? The truth is that life insurance industries had to evolve to compete with the investment industry, right? When all the money swings to the investment industry, the life insurance industry says, how do we get some of it back? And the answer is they build policies that have investment vehicles and investment features. There's also some serious tax benefits. So the idea that you're talking about is really accurate, right? The idea is at some point I build up enough of a cash value that if I stopped paying on my life insurance policy, the premium could come from the cash value and sustain the rest of my life. In essence, I've got paid up permanent insurance, hence the name, right? And to your point earlier, you said 98% of term policies expire without paying a death benefit. They know that. Right? They take advantage of that. So if the goal is that it pays, by definition, it ought to be permanent coverage. All right. So I think in most people's situations, what you'd find is not all, certainly, but in a lot of people's situations anyway, the right kind of insurance coverage is probably a mix. In some cases, term insurance, in some cases, permanent, depending on if you want to leave a legacy for your loved ones. And there are a lot of benefits to doing that. Let's talk just a little bit then about the other side of the question, which is, all right, so now I know why I should have it. I know what type I should have or some combination of it. How much should I have, Kyle? How do you coach people through that question?
Yeah, we love throwing out analogies, so I'll give you one. Think of a football field, right? You have the end zones on either end. So there's one end, the human lifetime approach, and then the needs approach. So the needs approach is really 2 times whatever your current salary is right now, plus any debt you have out there, right? The idea is that, God forbid, something happens to you, you can pay off those debts, and your beneficiary has 2 years to kind of recover and figure out what they're going to do for moving forward.
Yeah, that's really important because we talked about that last time, right? We talked about, unfortunately in our experience, a lot of financial consumers make bad decisions, and often those bad decisions are compounded by emotion. So what I heard you just say is, you're talking about at a minimum with the needs approach, the idea that if something were to happen, they could pay off everything that's owed and they could grieve for 2 years without having to worry about any changes to their lifestyle. And the idea is that the emotion can subside. It'll never go away. If you've ever lost a loved one, you know that it's always there. But at least it come down and put you in a position where the emotion's not as impactful in the decision-making process. You mentioned the other side, the human value. Talk a little bit about that one.
Yeah, I think of that as kind of replacing your income during your working years, right? So if you're mid-30s, let's say 35, you planned on working for another 30 years and you're currently making, $50,000, right? It's that 50,000, not exactly because you're taking into account some taxes over time, right? But you're basically replicating what your income would be, over that missed period of time, whether that's 30 years, 20, whatever.
Yeah, that's interesting, right? So I'll give you an example. Like that's, when I think about that, I think about, the guy in the wrongful death lawsuit that you heard about got killed on the job and there was somebody at fault and they sued the company for $11.623 million. And you always ask yourself, how did they come up with that, right? That's the human life value. They took that, what human life value really measures is the loss to the economic loss to your family if you don't come home tomorrow, right? So you take your earnings, you project it out over your working lifespan, you build a little inflation in there, you account a little bit for taxes, and what you get is an actuarial calculation that says 11.6235, right? Some odd number. And the other point I'd make about that one, tell me if you've heard this. You ever ask anybody, I've coached a lot of families too around life insurance, Kyle. One of my favorite questions is, if your wife were to be killed in a wrongful death situation, God forbid, right? Obviously, but in that example, do you think if you found out, as an example, maybe she got hit today on the road by a UPS driver, and then you find out the UPS driver was drinking at lunch, right? Wouldn't you sue UPS? And what would you sue for? What do you think when you ask that question, the most common answer is?
I don't know.
Yeah, believe it or not, most people say $10 million. And I always think that's interesting. Like you value your spouse at $10 million, but you got $100,000 of term life insurance on her life, right? There's a disconnect there.
There is.
And there's also a disconnect around stay at home. Is your wife stay at home?
She works.
She works?
Yep.
Mine's stay at home. The thing about, and she has for a long time, we started moving around the country for my job starting in 2005, and my wife moved, and my daughter was 9 months at the time. So she stayed home to raise our kids, and I'm really thankful for that. But there's not a financial planning tool out there that would say I need life insurance on my wife because I'm the breadwinner and I could just go to work tomorrow. Except that it doesn't take into account at all the things that she does for my family, right? The shopping, the cooking, she takes care of the house, she takes care of the yard, she manages the business of the family, right? All those things, if I had to do them without her, there'd be a cost to that, right? So, life insurance is an interesting thing. What's the right amount then? You got this needs approach on one end of using your analogy in the end zone. On the other end zone, you got the human life value. What's the right amount?
I think it's a continued conversation. You bring up kind of the two goalposts. You see, frankly, how the client feels about both. Usually, if we're talking like specifically about term, term seems to be a little bit more affordable compared to, say, permanent. You get a little bit more with permanent, right, over time. So you talk through the pros and cons of each, right? You find out where the client wants to be. And end of the day, like where they want to be, not only now, but 10, 20, 30 years from now. And that helps you kind of figure out. So like my personal situation, I ran it for myself and my wife like 2 years ago. And we ended, somewhere in the middle of the two, right? Because it's, hey, pay off debts, but also taking into consideration income and certain events that'll occur in the future, right, for my daughter, such as like a wedding or a school, right? So it's honestly an ongoing conversation that we have with somebody. And, if I ever come to you telling you, hey, you need to do this dollar amount, I'm not really listening to you, right? So I let the client kind of dictate that to a degree.
Yeah, that's interesting. Here's what I know, right? The average person buys life insurance 7 times in their life. Right. The truth is, and it's usually driven around life events. We buy a bigger house. We get a new job. We have another child. Right. It's usually life event driven. And what I know is as you get older, life insurance gets more expensive, not cheaper. So one of the fundamental concepts that we try to help our clients with is, what if you bought a lot of insurance while it was cheap and you were younger and you lowered it as you got older, right? And you forecast out a little bit about things like I love that you're already thinking about your 2-year-old's wedding and providing resources for that, right? That's really what planning is. It's thinking about the adversity that you could face at some point in your life and making sure that you're prepared. And by the way, there's no right answer, right? What I might want to do with my family's future might be different than yours, but by pulling it out and having a conversation about it, we can plan around it.
Right.
Kyle, this has been really good. I think these are two of the more common questions that we get, and frankly, I think the insurance industry, they make it clear as mud sometimes, right? And they like it that way. So thanks for making this a little bit easier. I'll look forward to having you back on the podcast soon.
You bet.
Awesome.
Thank you.
Thanks, Kyle.